Hi everyone, it's Jack back with a video. Today I'm going to be talking about the latest company that Warren Buffett's been buying. His first major purchase in a while, and he's buying more of Occidental Petroleum, US-based oil and gas company with some exposures to the Middle East and Colombia, but it's mainly in the Permian Basin in the US. Bought over $1 billion worth this week, now owns 136 million shares, 18 million of these purchased between Monday and Wednesday last week. Buffett owns a ton of preferred stock in Occidental after helping to fund their $35 billion purchase of Anadarko in 2019. This is done at a really favourable rate and it pays a decent dividend. Classic Buffett move. Now got a 14.6% stake in the company, so really attracting some eyeballs, and whether this is going to be his famous elephant gun purchase. Occidental has a long and rich history, but to tell the truth, over the last 5 years it's been a below average stock, down nearly 20%, handily losing to the market. Of course, this doesn't tell the full story. Of course, there are many times when you could have bought it and made decent money. Since the lows of $9 in October 2020 when oil was dirt cheap, the stock has returned over 500%, nearly 600% actually. Profits being tied to oil and gas work both ways, of course, on the up and down. Clearly, as oil and gas prices have rose tremendously, this has massively benefited Occidental, and the stock price has just completely ballooned. Taking a look at the company's balance sheet and profitability metrics, absolutely not a classic Buffett pick by these metrics. Company's balance sheet could definitely do with some work. Cash to debt ratio of 0.09 is not impressive at all. Cash on the balance sheet of around $2.7 billion to around $30 billion of debt. Very, very unimpressive. They're working to pay down this debt and are making good steps. But this debt load is concerning, combined with the variable profits, definitely concerning, does not put the business on good footing. Debt to EBITDA of 2.26 shows right now at current oil prices, debt is well covered. Almost score of 1.27 indicates that this is not a financially stable company at all, and it's at risk of financial distress in the near future, which of course is possible with oil prices maintaining as they are, above $100. I'm not so concerned about this. I think anything above $80 is absolutely tremendous for Occidental. Margins again, obviously variable due to oil and gas being commoditised. Right now operating margin of strong 18%. Pretty good for the industry, pretty good for Occidental. Net margin of 8.95. Again, decent number for the industry and a very good number for Occidental's history or recent history. Return on equity percentage of 8.02 and return on assets percentage of 2.98. Not particularly impressive at all. Below what I would expect for this, I'd probably expect return on equity of between 10 and 20, 20 being very good, 10 being okay. Return on assets between 5 and 15, 2.98, not very impressive. Again, but decent for Occidental's history, but not something to be overly concerned about. Return on invested capital of just shy of 5%. Again, not incredibly impressive, but not something to be overly concerned about because these are variable companies and you really have to kind of time your investments in these companies, as I think Buffett's trying to do. Looking at some the basic valuation metrics and ratios, one that jumps out immediately is the trailing PE ratio of 36.7, not particularly eye-catching, but a forward PE of 15, slightly below the S&P 500 average, significantly cheaper than the trailing PE ratio, indicating a discount to the wider market on a forward basis. None of these particularly eye-catching to me, except, of course, price free cash flow and price to operating cash flow. I think this is one of the metrics Buffett will have been looking at. Price to free cash flow, 7.08, very cheap for the oil and gas industry and the energy sector in general. Very cheap for any company. Price free cash flow of 7, excellent for Occidental's history, some of the cheapest metrics you'll have found for this company in a long time. Again, because they're generating so much cash flow because of the wider oil and gas prices. Price to operating cash flow, 5.19. Very, very cheap. Some of the cheapest you'll see in the industry and very cheap for Occidental's history. The company has excellent free cash flows and they hope to maintain them going forward. Occidental had an absolutely excellent year in 2021 and they hope it can continue into the next year, particularly relative to the weakness experienced in 2020. This is an absolutely fantastic turnaround year and I'm very impressed with it. They set numerous records. They exceeded their initial 2021 production guidance by a significant amount. Multiple drilling and completion records set across the business. OxyChem had record earnings, although this isn't very significant in the wider business. It's a small percentage of the business. In terms of financials, record free cash flow before working capital of $8.8 billion. This is a $56 billion company, so you can see that's an enormous amount of money. Retired $6.7 billion of debt. The company still has $30 billion in debt, but this is a tremendous slice that to get rid of. Large-scale divestiture program complete, substantial progress towards reducing that net debt down after the purchase of Anadarko and some other things. getting it down to 25 billion. They're on the way there. Another year like this, and they'll have surpassed that target, longer term target of 20 billion. Again, completely achievable if they keep on going at this rate. Management's capital allocation strategy is really absolutely rock solid and commendable in my opinion. The 2022 cash flow priorities are any excess cash flow continues to be allocated to balance sheet improvements, and then they can allocate money to shareholder return once these net debt targets are achieved and not before. I think this is a good framework for a lot of companies that are in financial distress to follow, or close to financial distress. So basically, they'll pay down the debt, then they'll think about growing the dividend, then they'll think about repurchasing shares, and then longer term, they hope this will settle with a financially stable company that's able to repurchase and pay back to shareholders at a good rate. Their clear targets with this is to prioritise retirement of an additional $5 billion of debt to drive down to that next milestone of $20 billion, and they want to return to an investment grade business and improve the credit rating. They want to increase the common dividend to $0.13 per share per quarter. Decent yield, roughly comparison with the S&P 500, nothing super impressive. And share repurchases, they're reactivating and expanding the share repurchase program to repurchase $3 billion of shares, which at current prices, $56 billion market cap, it's more than 5% of shares. That's an impressive chunk, and that'll be meaningful to shareholders in the short term and long term. Next, I have my analysis to do a discounted cash flow calculation, which I don't think is entirely straightforward here. I've used 5% free cash flow growth rate and a 9% discount rate to work out a fair value of $108.86 compared to a current present day stock rate of around $60. Now this of course doesn't paint the entire picture. That 5% free cash flow growth is by no means guaranteed. You can see, looking at the annual year end numbers on the right hand side, December 2019 they had $0.94 of free cash flow per share, 0.98 in December 20, and in December 2021 they had nearly $8. So that's a tremendous growth year over year. Basically skews all the numbers. And looking at the fair value at the current stock price, the fair value, if you expect no free cash flow growth at all, is roughly the current stock price, around $60. If you expect just 5%, that's $108. So effectively, this discounted cash flow calculation is meaningless for this company. What you're predicting is, our oil price is going to stay the same or above, and can Occidental benefit from this? And I think that's a tough ask. I've purely showed this discounted cash flow to give an idea of, if you believe are bullish on the oil industry, bullish on the industry sector, and bullish on oil prices, then 5% free cash flow growth doesn't seem like a whole lot, and it gives it tremendous fair value. But right now, if it can just maintain its current free cash flow numbers of $8, which again is a hugely tough ask and pretty much unpredictable, then they're essentially fair value. So what do I think of the company? Well, first of all, Warren Buffett is arguably the best investor of all time. So who am I really to question him? His initial financing deal was classic Buffett, and clearly now he sees some more opportunity here. This is not exactly bargain basement, but the business is cheap by a lot of metrics. 7 times free cash flow, 5 times operating flow, and by my estimation the business is fair value if you assume no free cash flow growth and only maintenance. So basically any free cash flow growth over the next 5-10 years and this business will look very cheap. However, this is not a business I'll be investing in, because truth be told, I think the oil and gas sector right now is a complete mess. Predicting anything is so unpredictable with the current things that are going on in the world. I think, as Buffett often says, he's making a wider bet on America, the American economy and the American oil industry, but I'm just not comfortable investing something that may not be around to the same extent it is in 30, 40, 50 years. That being said, I believe that this is a strong company right now. I'm just not a short-term investor. I think this is a relatively short-term investment. I won't be surprised if Buffett has sold his investment in 5 to 10 years, and they're the type of investments that I'm not really so interested in, purely not as any sort of global warming or anything like that. It's purely because I think this is just too hard. I don't tend to shy away from businesses where you have to predict commodity prices, and generally businesses that are where the free cash flow and the profits are largely out of their hands, and that's what I think the situation is for Occidental, so I won't be investing. But of course, none of this is financial advice. You should do your own research and due diligence and form your own opinions without just listening to me. If you've enjoyed the video, please like and subscribe, help the channel grow, and I'll see you again next time.